Bismillahirrahmanirrahim. So, in the previous class, we discussed about profitability ratios, and then we discussed about the problems in the profitability trend analysis, and then we discussed about summary of the whole ratio analysis. Today we are going to start another analysis that is called common size analysis. What is basically common size analysis? It is an analysis of percentage financial statements where all balance sheet items are divided by total assets and all income statement items are divided by net sales or revenues. Basically, in common size analysis, what are we doing? We are converting all the items of income statement and balance sheet to percentages. And what is the method of converting these to percentages is that all balance sheet items will be divided by total assets and all income statement items will be divided by net sales or revenue. How? So we will check. Now see, up to this point, this. I can't hide it. I don't know how to do it. Okay, whatever. This data will be given to you. 2001, 2002, 2003. This is balance sheet. This is the asset side. Sorry, this is the total balance sheet. So these are assets. Yes, this is the asset side. This is the liability plus equity side. Now what will we do? Here, 2001, we will convert this cash to percentage. This item 148, see this is 2001, we convert it to percentage. What is the procedure? Take 148, divide it by total assets. So 148 divided by 1223 multiplied by 100. So we are getting 12.10. I will check the calculator. It is here. Now see, this is cash 148. So I told you what we will do in common size analysis. We will convert the balance sheet into percentage. What is the procedure? Take all items 148 divided by total assets. So 148 divided by 1223 multiplied by 100. So see, we got 12.10. So see, this is 12.10. This is common size or percentages. Means in common size, we are converting the balance sheet to percentages. So this is 12.10. Now the second item, see, account receivable 283 divided by 1223. 283 divided by 1223 multiplied by 100. So see, we got 23.14%. Similarly, inventory 322 divided by 1223. 322 divided by 1223 multiplied by 100. So we got 26.32. When we round it, we got 26.33. Then this 10 divided by 1223, 10 divided by 1, 2, 2, 3 multiplied by 100. So check out 0.817. So they round it 7, so 0.82, this one. Similarly, this divided by this, then 349 divided by this, then 0 divided by this, then 111 divided by this. So this is 2001 conversion to percentages. And see, total assets, it is equal to 100% because we are comparing all the items to the total assets. Then in 2002, 100 divided by 2044, 100 divided by 2044, sorry, 2044 multiplied by 100. So see, we got 4.89. Then the next item, 410, account receivable divided by total assets. 410 divided by 2044 multiplied by 100. So we got 20.06. Similarly, this divided by this, then 14 divided by this, then 1140 divided by this. So we are getting all these percentages. Similarly, for 2003, first item 90 divided by 2169, then 394 divided by 2169. So we will get these percentages. So basically, common size analysis, it is converting your regular 1000 balance sheet 2001, 2002, 2003 to common size, that is percentage balance sheet. So see, up to this point it is in dollars, 3 years data, but after this point 2001, 2002, 2003, this is in percentages. Similarly, the liability side, this one, this divided by this, then this divided by this, then this divided by this, this divided by this, this divided by this, all this. So we convert it to percentages. So this is basically called common size analysis. Now, what to do with this analysis? What is basically this? Is it good? Is it bad? We don't know. So now we will understand that whether there is increase in these items, there is decrease in these items, increase is good, decrease is good, what? So now check out the first item, cash. It was 12% in 2001. It comes down to 4.89% and then comes down to 4.15%. So cash is going down. So is it good? Is it bad? So what do you think? I think cash is going down, so it will be a bad position. You will be thinking about this thing, that cash is going down, so it is not good for the business. No, cash is going down, it is a good thing. Because previously we have 12% cash in our business. It was idle cash. We were not utilizing this cash. Now what we did out of this 148, now it is 100. So we took the money and we invest it here. See, from 0, long-term investment goes to 50 and then 50. So it is indicating that cash is going down because of our long-term investment. We invest this money in long-term investment, so this will give us some return on that investment. This was cash with you. It was in either in bank or in your business, but it was idle cash, 148,000. So what we did, out of 148,000, we took 50,000, we invested in long-term investments. So because of this, our cash management, it becomes good. The second thing is account receivable. 23% comes down to 20%, comes down to 18.17%. So account receivable is going down. This is indicating the efficiency of the collection of the company. Previously in 2001, our total account receivable at the end of year, it was 23%. Now it is 20. Now it is 18.17. Our sale is increasing, but our account receivable, it is going down. So it is indicating the efficiency. Now you are collecting the account receivable quickly as compared to 2001. It was 23%. Now it is 18%. And if you remind the ratio analysis, it was 85 days in 2001. And then it comes down to 65 days in 2003. So this is indicating the same point. It is indicating that we are quickly collecting our accounts receivable. Then inventory, 26% goes up to 30% to 32%. So this thing is showing increase in inventory, which is not a good point. Why? Inventory is increasing. When inventory is increasing, it is showing us a point, a weakness of our marketing and selling department, that they are not making efforts in selling the inventory. That's why inventory is going up. One thing is that you're purchasing more inventory, but when you purchase more inventory, the main thing is that you have to sell this inventory. You're purchasing the inventory and you're not selling that, so your inventory account will go up. So see, it is going up, which is showing a weak point of your marketing and selling department. Other current assets, so there are lots of other current assets, so we can't analyze this, because if you have individual, so then you can analyze this. Total current assets, so see, it was 62%, comes down to 55, then comes down to 55.09. This reduction is because of cash is decreased and accounts receivable are decreased. So because of these two items, the net impact on total current asset, it also comes down, which is a good point, because now you are managing your current assets efficiently and effectively as compared to 2001. Then fixed assets, there is increase in fixed assets from 28% to 30% to 32.32%. So it is showing that we are expanding the business. Fixed assets are land, building, furniture, machinery, and these things. And if there is increase in these, so it is showing us expansion in the business, which is a good point. Then long-term investment, so it is increasing to 2.45 to 2.31. which is indicating a good point that you are investing your idle cash in long-term investments. Then other long term, so there are a lot of things coming in these other long terms. These are also increasing. So all these things are showing a good point that these are increasing other long term, so which is indicating expansion in the business. Now come to liability side. Note payable 23, 14, 13.37. There is decrease in note payable and account payable. See, so it is indicating that the company is quickly making payment to their suppliers. From one point of view it is good, but from other point of view it is not good. How it is good? You're quickly making payment to your suppliers, so your suppliers will trust you. It is good for the reputation of the company. But when you're paying money quickly to the suppliers, it is indicating the weakness of your cash management, because you're making payment quickly, so you can utilize this cash for some more days. You can use it in your business. Accrued taxes means the tax liabilities, it is coming down, so it is indicating that company is making payment of the taxes. Other accrued, so other accrueds are increasing. So in other accrued there is salaries payable, there is, you can say, bills payable, different type of bills payable. So these are also increasing, so you can say that there is some liability, other accrued liabilities which are increasing, which is not a good point. Total current liability, so it is coming down, and it is because of this thing, note payable. So total current assets are going down, so it is showing the promptness, the quickness of the current liabilities by the company. Long-term debt from 12 it goes up to 22, goes up to 24. So long-term debt is increasing, which is showing a good point, because company is thinking about the expansion in the business. That's why they are taking long-term debts. Equity 55, it comes down to 53, comes down to 52. When your debts are increasing, your equity automatically will come down. How? You know about this. Assets is equal to liability plus equity. Now suppose 100% assets. Suppose your liabilities were 30% and equity was 70%. Now what happened? You took more liabilities and your liabilities goes up to 40%. When your liability goes up to 40%, so automatically your equity, it will come down to 60%. So it will become 100. So increase in liability will automatically reduce the equity, the shareholders' equity. So same is the case here. Increase in debt, see 12 to 22. So 12, 55.11, equity, it comes down to 53. Then again it comes down to 52.51. So it is indicating that increase in debt will decrease the equity. Now come to the income statement. Same case. Sales, it is equal to 100%. Now we are converting income statement to percentages. So what will we do? We will take this 849, we will divide it by 1, 2, 3, 5. Item divided by net sales. So we got 68.7. Next year, cost of goods sold divided by sales, 71.3. 1599 to 2211. So we got 72.3. So see, cost of goods sold, it is increasing, which is a weak point because our cost, it is increasing. Cost of goods sold is increasing, which is not good. Gross profit, so again 386 divided by 1235, we got 31. 605 2106, we got 28.7. 612 2211, so we got 27.7. I told you in the definition, all items of balance sheet will be divided by total assets, and all items of income statement will be divided by net sales. So this is item gross profit. We will divide it by net sales, 1, 2, 3, 5, this thing. So we are getting these percentages. So our gross profit, it is going down, which is a weak point. Selling, general and admin expenses. So see, 14.6 goes up to 18.2, 18.2. We identify this point in the ratio analysis. So see here, it is now clear. It was 14% in 2001. In 2002, selling, general, admin expenses goes to 18.2 and 18.2. So administrative expenses, these are also going up, which is not a good sign. EBIT, earning before interest and taxes, 16.7, 10.5, 9.5. So our earnings, these are going down. EBIT is going down. Interest expenses from 1.6 it goes up to 2.4, goes up to 2.7. So the interest expenses are going up because there is increase in the debts of the company. When you will take more debts, when you will take more loans, so you will pay more interest. So same is the case here, 1.6, 2.4, 2.7. Then EBT, 15.1, 8.1, 6.8. Our earning before taxes, it is going down, which is not good. Earning after taxes, that is net profit, you can say 9.1, 4.9, 4.1. So our net profit, it is also going down, so which is not a good point. And all these profitability ratios are going down because of this cost of goods sold, it is going up. And this admin expenses, these are also going up. So this is the main reason for decrease in our profits. And cash dividends, we are paying 4% cash dividend in 2001, then it comes down to 2.4, and then it comes down to 2.3. Means the dividends payments that we are making to our shareholders, it is also going down, so which is a weak point. So in this class we discussed about the common size analysis, and I told you about how to analyze this percentage income statement and percentage balance sheet. I think for today it is enough. So inshallah in the next class then we will talk about other things. Assalamu alaikum.